overall, I find that the that kind of long-term debt cycle, the 40s, is kind of, I think, for me, kind of the biggest kind of framework for thinking about it. And then what I do is I go to these other periods and I find those similarities. So the 60s, like we said, as the equity comparison and the energy comparison. Another analog you can use that, for example, Luke Groban uses is Europe in the 20s, 30s, and 40s, because back then the United States was in some ways like the emerging market. We were the rising power. And so we were the creditor nation, we were the exporter, and some of those had their industrial bases damaged from the war. The UK had trade deficits, and so he uses some of the more European analogs for determining where we are in the cycle. And I think there's a lot of validity to that. And so I basically kind of go through these kind of one by one and kind of put a patchwork together to come up with the closest thing. Another thing is, in terms of say hypothetically how TIPS would do or how short-term treasuries would do in general, a big difference between the 40s and the 70s is if you parked your money in those shorter-term treasuries, you could retain at least somewhat more of your purchasing power than you could in the 40s, because in the 70s those short-term rates would eventually adjust to kind of keep up with inflation as the Fed tried to fight it, whereas in the 40s, because they completely gave up from the start on fighting that inflation and instead capped the yield curve, those short-term ones actually did even worse than the long-term ones. And so really kind of there's nuances like that are helpful to know when navigating this. I'm bearish in real terms on bonds in general globally, especially sovereign debt and longer-term bonds. A caveat is, again, going back to the 70s, shorter-term bonds could protect you more than longer-term bonds, because as yields went up, you could roll your shorter-term bonds into newer issues with higher yields. You still didn't do great, but you did okay. Whereas in the 40s, the ironic thing was that even though you had inflation, longer-term bonds did better because the whole yield curve was capped. And so basically, if you were holding a 10-year, you were getting like 2.5% yield, and you just kind of holding that for the decade pretty much. It wasn't going any higher, and you were getting inflated away, but you were still earning 2.5%. Whereas if you were holding T-bills, you were getting paid less than 0.5%, and still getting that inflation. And so actually, you had a weird thing. If you look at the central bank balance sheet, because in order to do yield curve control, they had to buy a lot of bonds. They basically had to have an open bid in order to buy bonds to defend their peg. And what you saw is in the early phase, they bought a lot of long duration. But then as this went on and the market saw that the Fed's yield curve control was credible, they started to say, well, wait, I mean, if we have an artificial positive yield curve just pegged here, then I'd rather just hold the long-term stuff and at least get a small yield. And so the Fed actually had to twist this entire balance sheet because nobody wanted the T-bills. Everyone wanted the longer-term stuff. And so the Fed had to change their structure, basically do an operation twist, but in reverse, to accommodate that shifting demand. And the Fed, they wrote a paper back in, I believe it was 2019. It was published in early 2020, right before this whole pandemic thing happened, and they went back and reviewed that whole situation, and they talked about the challenges of doing yield curve control in the way that they did. And so there are nuances for what duration you want to own in this sort of environment, but the general structure is that I'm bearish on bonds. I like TIPS, better than normal bonds, kind of like the least bad thing in the pile is a way of looking at it. But yeah, one of my overall theses is to find things to replace bonds with, because I do think that most portfolios are structured with the idea of the past 20, 30, 40 years of structural disinflation from a high inflation level, which is very good for the 60-40 portfolio, and that inverse correlation. And so everyone's kind of positioned to fight the last battle. And so I think that's not a great portfolio going forward. And so yeah, I structurally agree that I generally want things other than bonds, with the caveat being that if you can have some cash or T-bills or bonds for dry powder, if for whatever reason you have a view that equity markets are going to perform poorly over a specific time frame, and you can kind of rebalance into that. But that overall, the more you hold in those bonds and cash longer term, you're locking in a nearly guaranteed flat to negative return, real return. If we were to go back in history before Bitcoin existed, gold would be the go-to for this. It's kind of an alternative currency. It's got, if you look at history, it's got anywhere between a 1 to 2% annual growth rate in terms of estimated supply growth per year. It's extremely stable. It's very, very hard to produce more gold quickly, even when the gold price spikes. And so you have this very stable kind of hard money currency. And, there's not a lot of demand for that in an environment of stable monetary policy where you have positive real yields, because there's an opportunity cost for holding this zero yielding asset. But when you're in an environment of inflation, and then specifically inflation that's higher than the interest rates, then suddenly a zero yielding asset looks a lot better than a negative yielding asset that they're printing a lot more of. And so that's why, for example, if you look at the 80s, inflation was still high, but gold did poorly because by that point, yields were above inflation. And so there was a case, Volcker had addressed the negative yield concern. And so, after gold had that bubble, a lot of capital wanted to get back into treasuries because you actually had a positive real return now. And so gold has been a great, protection against, the devaluation of currency and bonds. But of course, now with the invention of Bitcoin, we have this other asset that we could explore, and that is, taken arguably market share and also just thought share and basically mind share from gold. And so we have this, again, we have a scarce, money that doesn't, we know it's supply issuance. We know that it has this hard cap. It's for the most part globally accessible. And this is, this kind of sovereign debt problem is mostly a global phenomenon, at least among developed countries. But of course, you also see inflationary events even more thoroughly in emerging markets for mostly separate reasons. And so there's naturally a demand for this, especially in an environment where we're going to have probably persistently negative real yields for quite some time. And the caveat of say you look over the past 12 years or say 10 years of Bitcoin's price history, and it's not necessarily like this one-to-one in, say, inflation hedge, because it's, for most of that time, it's this very small, volatile, kind of crazy asset. And so it's kind of like how if you look at, say, a growth stock in the early days, it tends to not be super correlated with anything in some cases because it's kind of on its own cycle. It doesn't really care about recessions, for example, because it's growing at like 40% a year and it's eating its competitors. And so it's going to grow regardless of what the economy is doing. But of course, once it gets big enough and it becomes the sector, then it becomes more susceptible to those cycles. And so Bitcoin in the first decade or so is this emerging asset class from zero. And so it doesn't fulfill its inflation hedge or store of, it's like an emergent store of value is how I describe it. It's this asset that the market is kind of testing and getting to know, and it's exploring its total addressable market cap, and it's kind of coming into its own as a store of value, inflation hedge type asset. So a lot of those kind of historical comparisons for it, or as much as you can call 1 decade historical, are not going to show this precise defense against inflation or financial chaos like we saw in March 2020 when Bitcoin fell along with everything else. But I think the whole thesis is, if you understand it and if you come to understanding you think it's going to be successful, then it, I think in the long run, looking over the 2020s, it is likely to do very well compared to, negative real yielding bonds. Kind of like how, most hard assets should do pretty good in that environment. But then if you look at Bitcoin's qualities and for whatever reason you come to the conclusion that it's probably going to take market share from other things and become a bigger share than it currently is of global assets, then it would probably be one of the better ones, if not the best.
Before we continue, help us clicking that YouTube like button and subscribe now to our channel. This shows the algorithm that you valued this information. And it helps us spread that message. Sharing is caring. And now, let's continue.
Do you want to know one thing about crypto? I made over 3,000% in profit in a few weeks. Fact is, the traditional financial system, the traditional money system makes you poor, not rich. If you want to earn $500,000, $1 million, you have to wait until you're 50, 60, 70 in the traditional financial system, and you probably will still be broke. And you will be old. This is not a sexy combination, as you can imagine. But the question is, how can you start in crypto and make these profits? Where to invest? Where to start? My name is Gunnar and I'm from Germany, as you can hear, and things are a little bit different in Germany. More about that later on. Fact is, there are lots of different cryptocurrencies. It's a gigantic universe where beginners and professionals get easily lost. But there is light at the end of the tunnel. There are 7 key steps you need to follow to become successful in this market. You have to know them, and if you fail one of them, it's literally impossible to succeed in this market. Just an example, one of the key points is your exchange, and one of the biggest are, for example, Binance and Coinbase. These are trusted and well-established exchanges, but, and this is a big but, you won't find the super profitable coins on those exchanges. The unknown super profitable coins that get gigantic profits are not traded on those kind of exchanges. They are traded on much smaller insider platforms that are barely known. And I can tell you what those super secret exchanges are and why they are so profitable. And another super important thing are the right information sources. The point is, the internet is gigantic. There are hundreds and hundreds of YouTube channels, blogs, pages, and much more. And there are also market makers and influencers. For example, Elon Musk, he is not a crypto guy, but the moment he recommended Dogecoin, it went through the roof, to the moon, so to say. But why did he recommend it? Where did he hear it from? He didn't hear it from newspapers. And believe me, he is listening to someone. But you have to know who, and you have to react before he is reacting. This is really important. And these are only 2 of the 7 steps you have to follow in order to be successful in crypto. And if you want to know all of these steps in much more detail, and if you want to have a comprehensive checklist, here's what you should do. There is a link below this video. Click on this link and you will get the opportunity to subscribe to my channel. Click on the link and you will see a video where I explain the next steps. So see you soon. Click on the link now. I'll see you there.